Hi, welcome back, and thank you for joining us for another installment of 52 and 52, in which I'm interviewing 52 Wisconsin professionals in 52 weeks and sharing them with you. So I'm sharing some expert ideas from the best of the best. Today with me I have Mr. Ken Riesch, the owner of R&R Insurance. This is actually part 3 of a 3-part interview. I'm not saying I'm never going to have him back. There's probably a pretty good likelihood I will. But today I wanted to ask Ken a specific question about the firming market. It's what we're calling sometimes the new, but the truth is the market's been extremely soft for a long time. My buyers expect large work comp dividends. They expect rates to go down, and they've been almost conditioned the opposite way of the health insurance side, where you almost expect an increase. That's changing. You meet with a lot of carrier heads. I know you sit through a lot of round tables and whatnot. Help the audience understand what is going on out in the market today.
Well, it's a very complex proposition, but I think just to look at some fundamental deliverables for businesses would give you a real good idea of why there's this ebb and flow in the marketplace. So we're coming out of what you would call a pretty soft market where we have seen, as the distributor of the product, the seller of work comp and property and liability insurance, we've seen those rates go down. It would not be uncommon for carriers to be passing on 3, 4, 5, 6, 7, 8% decreases, and at the same time, to enhance those businesses to stay with them, they may be offering worker compensation dividends. Can't guarantee dividends in the state of Wisconsin, but suggesting that they could return dividend to the policyholder in the forms of 25, 35, as high as 45%.
Right.
Well, you can only do that so long. There are factors that really drive a property casualty premiums income. One of the factors is what we call underwriting profit or underwriting loss. Another significant factor is their investment income, and then what their expenses are from a reinsurance standpoint, and just their general expense and base. But those 3 factors really drive businesses. If you look at what's happened over the last 4 years, the premium on an exposure base for businesses,
Right.
the premium has gone down, one, because their payrolls went down.
Sure.
If your workers' compensation contract was $100,000 and you were employing 100 people, if you go to 50 people and you're paying $50,000, it's down to $50,000. It's cut in half. And at the same time in workers' compensation, we've not really seen a decrease in medical inflation.
Right.
We've not seen a decrease in litigated claims. We've not seen decreases in the severity of losses. We have seen some frequency slow down, but severity not so. And a lot of it has to do with people losing their jobs, people being hurt in the jobs, not being able to be hired back, having to be retrained. So the comp costs have been driven up substantially. As a matter of fact, the combined for workers' compensation in 2011 was 117.5. Plainly put, if you take $100 from a customer, you're going to pay them back $117.50. That's not profitable. That's not a good economic sign.
And from what I understand back in my Wausau days was you could actually operate at 100 combined because you have investment income to offset that.
Think of the investment income
But
that
it's
you
not
would have
there.
had. What were those years, Tom?
That would have been, gosh, 2003, 2002, I was going to say when I started at Wausau.
Yeah, and absolutely those were. And in the 90s, they were also good years.
Right.
So then just think about the tornadoes that hit around our country in 2011 and 2010. I mean, really from April until October, maybe even November, you constantly turned on the TV.
Joplin.
We're hearing tremendous weather losses, just incredible weather-related losses. The wildfires out in Colorado,
Sure.
California, Arizona this year, the flooding on the East Coast, the hurricanes. We're coming in now to hurricane season. So the carriers have not made money. Property might be running at a 109 combined. I don't know what it's at this year. We had pretty good lack of bad weather the first quarter of this year. Second quarter, the property casualty companies haven't been so lucky. And still, investment income isn't anything to write home about. The investment income that really can take a combined from a 111 maybe to a 101, 102 isn't there. And we still have a substantial amount of litigation. Think of the advertising you see for if you're hurt on a job, if you're hurt in an automobile accident, if you slip and fall at someone's homes, give me a call.
Right.
Call me, I'll take care of you from stem to stern.
Sure.
So the hard and soft market goes back and forth. It almost is a 10-year
Sure.
cycle. So the company heads, when they visit with their actuaries, and they go through their reinsurance contracts, because in essence, the carrier acts as a middleman between the customer and the agent and the reinsurer. And that reinsurer passes on rate increases to the carrier. They turn around, pass those on to us. In general, if you're an account that's at an average number of claims, you're not in what we would call a depressed or severe class code, manufacturing dynamite, from a product standpoint, erecting 40, 50, 60-story buildings from a construction standpoint, you're going to get a 3 to a 7% rate increase is what the carriers are trying to pass along. That can be tempered if your business is growing. Some businesses, manufacturing is a classic example. In the state of Wisconsin, manufacturing has had a resurgence. I don't know if you could say everybody's back to pre-2009 levels of sales, but I think that manufacturing has come a long way back. Compared to construction, there is no comparison. Construction still is not very good. We're just now hearing for the first time of actually home development again.
Yeah, I think I read that for the first time since 2007. We broke the most ground.
That's right, and what people don't really realize is what the benchmark that was set for us in 2007.
Right, we're back to
maybe
zero.
how far underwater we really were.
Right.
We're not up to that benchmark. So the economy plays a big part, an environmental that plays a big mark in hard and soft markets. But we're definitely entering into what we would call a firming market. It's not a hard market, Tom.
Right.
A hard market would be where you actually pass on 25 to 35% rate increases, or the capacity of the carriers to be able to keep up with their premium to claims ratios gets out of whack, and they actually have to stop writing insurance and allow the premium to be earned. That's a capacity problem. We're not anywhere near that. And I don't think we're going to get to that point. I don't think we're going to get to that point. I think that the Great Recession leveled out much of the carriers from a premium standpoint. I think that they tightened themselves from a survival standpoint, from an expense standpoint. But I do foresee over the next 3-4 years, you're going to see on the property casualty side of the business rate increases 3, 4, 5, 6, 7%.
That's if you're good.
If you're not a good business, you've had a good business. If you've had lots of claims,
Right.
You don't operate a safe operation, you're not interested in return to work from a workers' compensation standpoint, managing your claims or your existing claims or claims that come up in the future, I can see your dividend dropping 10, 20, 30 points, and I can see rate 10, 15, 20% increases.
So the bottom line, it sort of just comes down to risk management, how well you implement that within your company, and profitability for the carrier.
Yeah, what we would say now is the time. We strive for it all the time, but now's the time to get your file in order. Your file in order is being able to say, here are the recommendations we comply with. Here's what we do from a return to work standpoint and workers' compensation. Here's what we do from a preventative standpoint. Here's what we do from a lockout, tagout standpoint. Actually, we may be investing in a whole new software program called Succeed that could very well help our carriers in that middle market area of premium. Say $100 to $100 premium up to $100,000, $150,000 a premium. Could be kind of neat. We would run it through our website, through our loss control people that we retain.
Yeah, because I do have concerns for my clients that are in that range that simply can't afford the luxury of hiring a safety director.
Absolutely.
And they already probably have people that are wearing too many hats in the first place.
Absolutely. A lot of those people were let go back in 08, 09, and 10.
Yeah.
Well, some of those companies have been running pretty bare from a safety standpoint. It's been a very difficult 4 years.
Yeah. Well, we have the firming market coming. It seems like if you employ the right techniques, we'll be able to get through it.
Absolutely.
Yeah.
Now is the time to be looking at your insurance costs. What can you do from a deductible on property? How can I raise, can I assume a little bit more risk and get a 10-15% income decrease on my property rate?
Mm-hmm.
That's not a big risk to take.
Right.
Liability. How do I control frequency of general liability claims? How can I control slips and falls if I'm a restaurant, grocery store? How can I control a large construction loss on a job site? What can I do as far as looking at my named insureds?
Right.
Controlling risk, contractual liability. There are techniques all put together. You, our resource people, can help roll those out to our customers. If they're not using them, they should be.
Mm-hmm.
And then the prospects that we look to hopefully write their insurance in the future.
Sounds good. Very good.
Hopefully I've asked you a question.
You did. Very good advice. Very good advice for the audience. I think by now everyone has pretty much heard that the firming market is here. But sometimes I think a lot of people forget that reinsurance is a huge factor in this. It's not always just the storms. I do still feel that a lot of these carriers do still have a significant surplus built up.
Well,
But they're just not as profitable as they used to be.
They do from their investment income, but I can tell you, because one, I sit on the boards of some carriers, and two, I'm on some organizations that actually review the capacity of many of the carriers that we do business with have been damaged significantly over the last 4 years.
I want to thank you for joining me
You're
today.
welcome.
Thank you, audience, for joining us for this 52 and 52. I hope you found it valuable. If you have any questions for Ken, I will put his contact information below. If you have any questions for me, please do the same. I'd love to be able to help you out. As he mentioned, there are definitely some ways to control the cost of your insurance premium. This year is probably a very good year to do it if you have not done so in the last couple. And beyond price, as Ken mentioned, gosh, we're rolling out a lot of great resources. A lot of great resources to go to your underwriter at the carrier and say, listen, we've done this, we've done that, we've done that. We don't deserve the rate increase you're trying to deliver to us at renewal. And we'd love that opportunity. So,
Talk to us about wellness.
and talk to us about wellness. We're combining work comp and wellness in a way you've probably never seen before, and it's going to be tremendous. So we hope to be able to at least have that conversation with you. And again, thanks for joining us, and we'll see you on the next edition of 52 and 52. Have a great day.